headlines remain focused on AI and mega-cap growth, something quieter has been unfolding beneath the surface. Value-oriented sectors, industrials, financials, energy, and dividend-paying companies have started to regain relative strength. The question investors should be asking isn't whether value is back, but whether this shift represents a structural change or simply another temporary rotation inside a growth-dominated cycle. Part of this move comes from the macro environment itself. Slower GDP momentum, persistent policy uncertainty, and a market that is no longer moving in a straight line have pushed investors toward balance sheet strength and earning visibility. While growth expectations moderate without collapsing, capital often gravitates towards companies with tangible cash flows and pricing power. That is why industrial leaders, select financials, and energy-linked businesses have begun to stabilize even while technology leadership pauses. This isn't necessarily a rejection of growth, it is a diversification of leadership. Another factor supporting value is the rate environment. Even when markets anticipate easier policy, interest rates remain structurally higher than the ultra-low era that fueled extreme multiple expansions in growth stock. Higher discount rates change how investors evaluate future earnings. Companies with nearer-term cash flows, a classic value characteristic, become relatively more attractive compared to businesses whose valuations rely heavily on long-dated expectations. That dynamic doesn't eliminate growth leadership, but it reduces the valuation gap that previously drove concentrated performance. Beyond rates, structural themes are also playing a role. Infrastructure spending, reshoring initiatives, defense investment, and energy transition projects are directing capital towards sectors historically classified as value. Industrials, materials, and certain financial institutions are benefiting from a renewed focus on real economy investment rather than purely digital expansion. In many ways, this reflects a broader shift. Markets are rewarding companies tied to production and logistics just as much as those tied to innovation narratives. So, is the comeback of value sustainable? History suggests rotations rarely move in straight lines. Periods of growth dominance often give way to phases where value regains relative traction, especially when macro uncertainty rises and earnings dispersion widens. However, a true structural shift would require continued capital expenditure cycles, sustained inflation stability, and a market environment where diversification matters more than momentum. If these conditions persist, value may not replace growth, but it could share leadership more evenly than in recent years. For portfolio construction, the takeaway may not be choosing growth or value, but understanding how the two interact across cycles. A balanced allocation that combines high-quality growth platforms with industrial, financial, and dividend-oriented exposure can help navigate markets that are transitioning from narrow leadership towards broader participation. Because the real story may not be a comeback, but a normalization. So markets evolve in phases, and sometimes the most important shifts aren't the loudest ones. They are the quiet rotation happening beneath the flat index headline. Whether value's resurgence proves structural or temporary will depend on growth expectations, policy direction, and durability of real economy investment cycles. This is FinTalk, where we look beyond the headlines and focus on how leadership in markets is truly changing. I'm Tammy Beck. See you next time.